Excel accounting practice problem. Adjusting entry related to accounts receivable, sales, revenue, or income. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it. If you have access to it, there's two tabs down below, an example tab and a practice tab. Practice tab starting out where we left off last time, the example tab in essence being an answer key. Let's take a look at it now. We're looking at an adjusting entry related to the sales item, and it will be tied to typically the accounts receivable as well. So we're usually, when we're thinking about sales, we're thinking about the cutoff. In this case, we're thinking about, are there items that have been entered but entered in the incorrect period? Specifically here, we're looking at invoices that possibly were entered after the cutoff date. In other words, after February 28th, the end of the month we're working on, and in March, but for which the work was actually done in the current month, and therefore on an accrual basis should be entered in the system in this month. Now you can imagine this from a normal work process. It's easy to think about how this could happen, especially with a job cost type of system. It could happen in a database program, for example, if you're entering information into the system. For example, a database program like a QuickBooks, something like that, would record the revenue on an accrual basis when you enter the invoice. Remember, when you enter the invoice, you usually increase the accounts receivable. The other side then go into sales or revenue at that point in time. It's done that way because the invoice is the form typically closest to the point at which the revenue was actually earned. But it may not be actually the same time period that the revenue was earned. For example, if you have a job cost type of system and you're basically billing out for your time or the time of your staff, if you're a CPA firm, a bookkeeper, or if you are a law firm, then you got to have the week or so that they're going to work, at least 2 weeks or a month, and then you're going to be billing for the time that they worked on, the time that they did, and that means you'll be billing later on after the work was done. So it's quite possible in that case then that you send the invoice out, in this case in March, after the cutoff date when the work was actually done in February, and theoretically then you should be pulling that revenue back into the period in which it was earned, even though the invoice was not entered until March. So that's going to be the idea. Now, if you add inventory in on this, which we will do, then you'd think it would be more likely that the revenue would be in the proper period, but it still could happen in that the invoice is going to be after the cutoff date. Now, when is the revenue earned if you have inventory? Typically when the inventory is changing hands, is now owned by the customer as opposed to you as the seller. So there you might be looking at shipping documents, for example. So we're going to use the as if we sold inventory and the invoice went in place in the following period, because it's a more complex transaction, even though it's easier to kind of visualize that kind of problem happening when you're talking about like a job cost system. And then we'll record the adjusting entry. Now, you can imagine this as well. You can say, well, won't that completely mess things up? Because the invoice has already been put in place in March. And if you enter an adjusting entry, which basically records it again as of the cutoff date, as of the end of February in our case, by the time March gets here, it will have been entered 2 times. And that's true. So we're going to have to also do a reversing entry so that that does not happen. So we on the adjusting side are going to say, I'm going to do an adjusting entry to make the financial statements correct, income proper as of the cutoff date in accordance with the accrual basis. This invoice should be included in there. And then I've got to make sure that I do a reversing entry and line it up so the bookkeeper doesn't have to make any adjustments. Now, you also might say, well, why don't I just take the invoice in like the QuickBooks system, for example, and just adjust the date and just redate it back before the cutoff? You could possibly do that, right? But you don't really, again, want to mess up the accounting system for the accounting department. They're doing a system that works for them on a job cost system or whatever they're using. They're basically, if they're billing every week or so and they have a set date on which they do the billing, you don't want to just go in there and say, I'm just going to adjust the due date back a day, right? You don't usually want to change it. What we want to do is then do another entry and then show the audit trail as to why we are doing it. And that's going to be the adjusting entry. Okay. So in essence, this is going to come down to just basically doing a entry that will be mirroring an invoice. So we're going to go back to the practice tab, and notice if you were doing this in accounting software, although it is mirroring an invoice, we wouldn't actually enter an invoice. We would do it with journal entries just like we are doing here, because we want to be able to see it as an adjusting entry. So let's do that now. It's going to be on 228. And so the normal invoice kind of journal entry would be accounts receivable. Accounts receivable would be impacted. And then we would have the sales tax payable. So the sales tax payable, which we're going to have to deal with another complication, which is why we want to deal with inventory, so we can deal with that complication of having to do the sales tax, which would also be impacted. And then the sales number down here, which would be impacted. And then we'd also have the cost of goods sold, and the inventory. So this is our normal kind of transaction if we're tracking inventory and having to deal with sales tax on a perpetual inventory method. I'm going to hit the indent here, and these two are going to be indented up top. And then we're going to pick up the amount. We're going to say, and this would be supported by the subledger. Now note, if I go all the way to the subledger on the right-hand side, we also kind of want to consider what's going to happen with all these subledgers, because now I'm dealing with accounts receivable and I'm dealing with inventory. So if I go over here, we're selling, I think, an ELP. It's going to be an ELP. So you might say, well, then I should adjust the subledger. And you could adjust the subledger if you're reporting it. But really what I'd like to do is not mess up the subledger, not touch the subledger, because I don't want it to mess up the behind the scenes stuff that's happening in the QuickBooks system. I would like to not have QuickBooks or whatever the accounting system they are using to have to see my adjusting entry and reversing entry in the subledger, because that's going to be confusing to them. So what I'd like to do, if possible, is to note it as just an adjusting entry, not have to post it to the subledger, and then reverse it so that we'll be back in balance subledger, tying out to the trial balance after the reversal has happened, so that my adjustment doesn't mess them up on the subledger. But we're going to be imagining that we're selling this $400 ELP. So I'm not going to adjust the subledger this time. We're going to keep that in mind as we look at the reversing entry and what's going to happen with the subledger though. And I'm going to say that this is going to be 400 cost of goods. The other side's going to inventory. And then we've got the sales, which we're going to just say is 500. The sales not being related to that subledger, because the sales price might be a markup from the cost of goods sold, but it's going to be different than the cost. We're going to imagine that the sales tax is a generic 5%. So 500 times 0.05 would be the sales tax. That means the accounts receivable would be the negative sum of these items, the plug number that we would be getting to the 525. We could, of course, match this out to the transaction that we're imagining was put in place by the system in March. We're just trying to do the same thing the system would have done if they entered an invoice in March, but do it before the cutoff. So it's as of the end of the current period. Let's record it out. We're going to say the accounts receivable is going to be up top, the AR. Let's go ahead and hide the reversing entries too, just so we don't get confused by that. AP to AQ, I get confused easy. And then right click and hide. So there we got that. Okay, so now we got the accounts receivable is in AM6. Got to get up early in the morning to record this one in the AM6 and enter. And then we're down here in the sales tax payable down below. Sales tax payable. We're in AM20 equals. We're going to be scrolling over to that $20. That's going to bring the balance up to the 579 here. Then we're at the sales on down below. We're going to add the sales on the income side of things. We are in AM26. AM26. Making our money in the AM area. So now we're at the 451. Then we're going to record the cost of goods sold, the 400 down here. Cost of the goods that are sold in AM28. AM28. You're not 28, you're older than that. AM28. And then we've got inventory. Inventory up there is going to be right here in AM7 equals, and we're going to be picking up that one. That brings the inventory down to the 4346. So we can see down here the impact on the net income is the difference between these two for these adjusting entry of $100 down here on the net income. Here's the total impact of the net income of our adjusting entries thus far. Now, let's post it to the general ledger. There's 2 points of concern. There's actually 3 points of concern here if you were to do this entry in a journal entry fashion into like accounting software. One is the accounts receivable, because like QuickBooks software won't let you, for example, enter data into the accounts receivable without entering a customer so it can track it on the subledger. Just like with the inventory, I would like not to put it on the subledger because I don't want it messing up the subledger, but QuickBooks forcing you to do that is kind of nice most of the time, because that makes it impossible for you to basically, or nearly impossible, to not have your subledger tie out. So that's one area we have to deal with. The sales tax payable is kind of like an accounts payable account. So that's something that we often track within like a widget type of thing in accounting software. So that's another area where I'm a little worried to post to the accounts payable, because I don't want to mess up their sales tax accounts payable subledger tracker kind of tool that they're going to be using. And then I've got the inventory, which also has a subledger to it that we're going to be a little bit worried about. So we want to keep those three things in mind. So I'm going to record this one to the subledger so we can see it. So let's go record this out. We're going to say, let's go record it to accounts receivable first in the general ledger. I'm going to make this green. And then let's go to the right-hand side. We're looking at accounts receivable, which is going to be here. There's the A to the R. This is on 228. We're in BB19. BB19 equals left to the wall. BB19. And we got the 525 in BB19. And that gives us the 22,701. That matches the 22,701 on the trial balance. We're out of balance on the general ledger. We're looking for the sales tax. Which is down here on the GL, on the trial balance, same order on the GL. So we got the assets. We've got the liabilities. We're looking for the sales tax in the CC on 228 sales tax. Actually, I want to put this in there as an ADJ to show they're all going to be as of the end of the month on 228. But let's show it as an ADJ, and then CD23 equals left to the wall. Then we're going to be picking up that sales tax. There is that. So it should be at the 579 now. 579. Let's go back to the AR on my way back here. Just on the way. It's on the way. It's not a problem. It's just on the way home. So we'll just do that little errand. And then we're going to have down here the sales tax at the 579. And then we've got the sales down here. The sales here. So let's go all the way to the right, same order in sales, all the way to the right, and that's going to be here. Let's call that an ADJ. We're in CT10, CT10. That's fun to say, CT10. And then we're at 500 there, picking up the 500, bringing it on up to the 58451. 58451 also should be on the trusty T to the B trial balance. So there it is, 58451. Then let's ungreenify these or bluify them, whichever way you want to say it. We're going to hit the drop down. You can find that blue. It's going to be in the more colors area. Standard. We're looking that blue right there, and okay. Now we're doing cost of goods sold. That's going to be like the fourth account on the income statement. So going to the right, assets, liabilities, in equity, cost of goods sold in CW. I see the W. It's right there, ADJ, and then we're in CX. CX10 equals left to the wall. 400. So that brings us to the 45,954. That should match what's on the trusty TB once again. So they're 45,954. And uno vez más, por favor. We're doing the inventory one more time. Inventory, that's going to be up top. So that's number 4. Scrolling to the right, picking up the inventory. I think that's the one that's hidden down here at the bottom. It's that hidden one down here. It's in BA31. It's in the ADJ. So we're in BB31. BB31. Left to the wall. And we're scrolling up. It's like a record from BB. BB's record, the blues. BB's. BB King. 4346. That should be on the inventory. Inventory 4346. We're back in balance again. Back in balance again. So then we got the subledgers. Now note that if you're talking about accounting software like a QuickBooks, QuickBooks might force you, even when you're not getting an invoice, to use a customer. Again, we kind of would like not to do that because it's going to mess up the subledgers and the tracking of the customer balances, but we might be forced to. Now, if you are, then you might say, well, I would rather not do that, and I might just make another accounts receivable account, calling it like accounts receivable 2, possibly setting it up not as an accounts receivable type of account, but rather as an other current asset, so that you can record your adjusting entry without messing up the subledger. That's one option. Another option would be to set up another customer instead of putting it in the actual customer that you're dealing with, so that it will be in the subledger, but possibly it won't mess up the actual customer subledger. And the third option is just to put it in the proper customer subledger and then reverse it, so it'll hopefully go in and out okay. So let's actually post it to the subledger. I'm gonna go to the right. The subledger is all the way to the right. It's going to be dealing with the accounts that are going to be by order of customer. Now let's assume that it was like Mr. Anderson that we actually wrote the invoice for. We could put it into Mr. Anderson's item, but then in the subledger, you're always going to have this adjusting entry, which we will reverse out. But the fact that it's done with a journal entry sometimes makes it difficult to tie out the two journal entries together like you would with an invoice. It's hard to match them out. It might show as open, for example. So you might go in here and say, okay, maybe I'll just make another ledger, make another customer, and just call it, this is my ADJ customer. ADJ customer. So and I'll tell the accounting department, don't worry about this one. It's actually related to that invoice for Anderson, but I'm going to put it down here on, this is going to be my ADJ entry, and then I'll reverse it so it's not in the detail for Anderson. You don't have to deal with it when you're trying to collect on the invoice. So EP17 equals left to the wall, and then I'll pick that one up all the way to the wall. So I'm going to post this accounts receivable to it here. So now we got this other customer that we just made up, and so it doesn't mess up the actual customer. Okay, so that is that one. That puts us back in balance, because if I add up my receivables, I'm back in balance 22,701. I still need to reverse that, but that will take care of that kind of QuickBooks problem. That matches out what's on the accounts receivable here. Then you got the sales tax payable. Same thing there. They might use a widget which tracks the sales tax, and I'm a little skeptical to post to the sales tax because I don't want to mess up their widget. I don't think it messes up their little widget thing, but if you're skeptical on that, depending on the kind of software they're using, again, you might create another sales tax payable account and say, this is my adjusting entry account, possibly making it a sub-account of the sales tax payable, so you can kind of collapse them together as one without messing up the actual account that's being used to do their little widget thing to track the sales tax. So that's one method you might use there. I'm not going to do anything different on this entry here. And then the inventory is the other one. Now, even QuickBooks doesn't force you, like they do with the accounts receivable, to enter something into the inventory subledger. So if they don't force you to do it, I would not do it. And then I'm going to say, I expect my inventory to be out of balance now by the $400, meaning this one's at the 4346. If I go to my inventory subledger, because I'm not tracking the fact that I decreased the inventory at this point in time by the 400, I should record a 400 decrease here. I'm out of balance by 400. I'm at the 4746 in the subledger. I'm okay with that, and I'm going to notify my, the accounting department that the subledger is not going to tie out because we have the adjusting entry, but I don't want it on the subledger because it's going to be correct once the invoice is put in place, and we're going to do the reversing entry. And so I would rather not have it kind of muddying up the subledger for the accounting department. So I'm not going to record it there. We'll be back in balance once we do the reversing entry. So next time, that's what we will do here. Now, obviously, you might want a note here. You might want to put a note and say, this is a note. This is ADDJ for invoice entered in March when work was done in February, and it was for, and let's say customer was Anderson, but created new customer to enter a DJ entry and not mess up sub ledger or something like that, right? And that can help, again, someone else that's doing this in the following year to know what to do without having to pick your mind for it, hopefully. So then we're going to say this is an adjusting entry, ADJ, and I think that is it. So we'll do the reversing entry next time.